know you're an investor in Uber, which has aspired to this sort of super app idea. We've seen Tencent really succeed at it. What do you make of Elon Musk's idea to try to turn Twitter into an everything app?
Good luck. It's hard. There hasn't. Look, we don't own Uber anymore, but we do own ByteDance, which obviously owns the very popular TikTok app. We do own. We were early investors in Alibaba Group, which is obviously, and then as well as Ant Financial, which has built a super app. I think he's got his work cut out to him, but we're sure going to talk about it, and in 3 to 5 years we're going to know. Did it work? Look, Elon I totally agree that he can't accomplish this. What he wants to try to do is a public company. I'm sure it's not, having not spent a ton of time looking at Twitter, I'm sure it's not the most efficiently run business. I'm sure there's tons of ways he can fix it. It will take a lot of time. He's amazing at sending rockets into space, and he proved the world wrong, with his car business. He obviously started his career in payments. Time will tell if he's successful in turning around Twitter. I think it's a very tall order, and it's not like Facebook and ByteDance are going to sit around doing nothing while he tries to do it. So.
From a bigger picture, I find it interesting that we could potentially see this massive deal, him buying Twitter for $44 billion, happen in the middle of, potentially a drop into a recession. We also saw Adobe agree to buy Figma for $20 billion, and we're waiting for this big Microsoft Activision deal. What do you think about how the M&A landscape is keeping up pace despite the fact that the economy is so bad?
Well, it's a great question. Corporates around the world have, and these tech corporates, Google, Microsoft, Facebook, Amazon, have, Alibaba, Tencent, have ginormous sums of cash. By the way, Oracle, you could add in there, SAP, you could add in there. At some point, I think we're going to wake up over the next 12 to 15, 18 months, and there's going to be a heck of a lot more M&A than we've seen in a long time. I don't know when it's going to happen. I don't think it's starting yet. I also think you're going to see a wave of buyout activity too. The problem, I think, why the LBO fund activity, private equity fund activity right now is pretty slow, and you've seen busted deals just because the credit markets are not in good shape. Just related, there's a huge backlog. There's a huge, we're not credit investors, but there is a huge log jam right now with the Citrix deal, and these banks are going to take ginormous losses on them. And so the credit markets for a lot of this activity is super slow. So I don't know how much leverage that Twitter is going to take in this buyout and things like that. But anything that requires and I think that's why you're seeing spreads on lots of potential deals trade pretty wide, because the credit markets are so uncertain right now. Now that doesn't impact strategics.
Let's talk about. Okay, let's talk then a little bit about venture and the private markets. Venture firms seem to have a lot of dry powder that is piling up, and not a lot of places to put it. Some folks have told us they're waiting for valuations to go down before they deploy anything. Of course, there are a lot of companies struggling, and suddenly their balance sheets don't look so attractive to investors. What are you seeing? How are you evolving your strategy as macroeconomic concerns remain?
Sure. So good economy, bad economy. I think nobody knows where the economy is going. I read an ISI survey that said 90% of investors think that there's going to be a recession in 2023. The crowd is usually wrong. It's not like we were all sitting around in February of 23, in February of 20 thinking, COVID was going to happen a month later, or in August of 08, the world's about to end because Lehman Brothers is about to blow up. Who knows? The crowd is usually wrong. By the way, I'm probably myself in the crowd. In terms of the venture landscape or growth equity landscape right now, and I think you can expand it to private equity landscape or real estate asset landscape. Specifically in venture, and if you're thinking hey, companies with 15 million of revenue to 100 million of revenue that are software and internet or fintech businesses, there's just too big a spread between what the buyer wants and what like a private equity or venture fund's going to pay, because it's driven by public markets. And in companies right now, for the most part, and I think the spread has already started to come down. Like it's definitely tightened up from today where it was 6 months ago. You just have to make the assumption that private markets lead public markets. Sorry, public markets lead private markets. And as a result, like tons of companies raise money in the back half of 21 and early in 22. And like they raised like 2 years of money. And so like you're a company right now that still has 100 million plus in the balance sheet. Your last round was probably done at too high a price, but like you don't have to raise money right now. Fast forward a year, you might be in a recession at that point. You've probably burned a bunch of money. We think it's going to take another 6 to 12 months for a lot of this stuff to work through, and that, you know, the back half of next year into 24 will be super busy, because then a bunch of these companies are going to raise. And those companies that hit or beat their numbers might raise up rounds, but those companies that miss their numbers will probably be raising down rounds. Again, who knows? Maybe not. Maybe public markets go back up, but if comps stay where they are today, which is kind of near historical averages.
So what advice are you giving your portfolio companies right now?
It's a great question. Don't panic, is one thing. Run your business like, you know, keep your best employees happy. You know, layoffs are not always bad. Like, you know, some of the greatest companies on earth over time have like laid off 5 to 10% of their people every year. Like GE was like well known for doing it 30 years ago, is trimming. Like all these companies are run with too much fat. Like every software company that's been funded with venture funding. So what are we telling them? That's a great question. I think we're telling them, look, make sure you've got capital for the next like 18 months. Make sure your unit economics work. So like, you know, you don't need 3 or 4 year customer paybacks. You pay it back in, you know, 18 months or under. But make sure you're invested in the future. Like, don't freak out. Like we're going to look back in 5 to 10 years from now, and like great companies will have been created during this time period. And you need to be bold. You just want to be smart about it and make sure you're not standing on the cliff, you know, with your pants down if the tide goes out.
Okay, don't panic, don't freak out, and don't stand on a cliff with your pants down. Those are all tangible pieces of advice, Mitch. One more question. I'm curious what your thoughts are on the IPO window. It seems to be firmly shut. Does it reopen in the next few weeks or before the end of the year, or not?
Probably. By the end of the year, probably not. I actually think, and not enough people are talking about this, I think next year, if you could get some stability in the markets, I think the IPOs could be like the future down rounds for lots of companies at scale. Like if you're like 100, 200 million, 300 million in revenue, and you raise some money at some crazy price, you could do like some structured equity deal. But if you're at the size and you're growing 30, 40, 50% a year, a structured equity deal can actually be really bad for your early investors or your early employees. It like creates really perverse incentives versus like do what Square did and just go public. And you know, a few years ago, there were a handful of companies that went public before their last round. Everybody converts into common stock, and like I don't think entrepreneurs should like feel bad about doing it. And like I think you're going to see over the next couple of years, probably starting next spring or summer, a bunch of companies that go public in flat or down rounds to their last, you know, privately funded round. And like, look, we're all big boys. Like some of us, probably ourselves included in some cases, like overpaid for an asset. But like, go public. It's a great way to raise capital.